Welcome to the deep dive. Ever wonder what really goes on when you open an investment account? Or maybe why your advisor asks so many questions?
Mm.
Well, today we're kind of pulling back the curtain on financial compliance. It's this like huge invisible system that keeps the financial world running.
Yeah, and it's there to protect you and the whole economy, really.
Exactly. So our mission today is to give you a shortcut, basically, a way to understand the key rules for opening accounts, making sure investments are, suitable for you, and even how they fight things like money laundering.
And I think you'll find some surprising stuff along the way.
I think so too.
And look, this isn't just jargon for finance people. Knowing these rules, it helps you. It helps you understand why they need certain info, what protections you actually have.
Yeah.
And we're drawing this from insights in navigating financial compliance, accounts, suitability, and AML. Gives a really solid overview.
Okay, great. So let's maybe start at the very beginning, like when you first decide to open an account.
Good place to start.
You might think it's just filling out a form, right? But it's
Huh.
actually more like creating this detailed digital fingerprint for security.
That's a good way to put it. For the firms, the broker-dealers, and the advisors, the registered reps you work with, um, following all these rules really starts the second you say, I want an account.
Okay.
Begins with getting all your information down, documenting it carefully. Good records are key. You know, they protect you, the customer, the firm, the rep, everyone.
So what information do they need? I always hear know your customer, KYC. What's that really about? Is it just knowing my name?
Well, yeah, but it's deeper. FINRA's KYC rule, it's not just verifying who you are. It says firms have to use reasonable diligence to know the essential facts about every customer.
Essential facts, like what?
Well, who you are, obviously, but also anyone else acting for you. And then there's the USA Patriot Act layer on top of that.
Ah, right. Post 9/11.
Exactly. That added more requirements specifically to fight terrorism financing. So firms don't just check who you are once. They have to keep monitoring things, ongoing, to comply with anti-money laundering rules, too.
So it's like an initial check and then keeping an eye out?
Yeah, building this whole profile over time.
Yeah,
It helps keep the system safe.
makes sense. So not just ID, but also understanding like my investment goals and financial situation. What specifics are they after and why before I even invest anything?
Precisely. That info on the new account form, it isn't just bureaucracy. It's genuinely there to help your rep and the firm understand what you want to achieve investment-wise and spot any suitability issues early on.
Okay.
It's like painting a full picture of your financial world.
Hmm.
Now, the forms might look slightly different from firm to firm, but they all have to get certain minimum details before they can even place your first trade. It's an industry standard.
Okay, minimum details.
Uh-huh.
What absolutely has to be there before anything happens.
Okay, so FINRA says the bare minimum is your name and your residence. And this is important. A P.O. box doesn't work for opening the account.
Oh, interesting. Why not?
They need a real physical address they can tie to you. You can get mail sent to a P.O. box later, but not for opening. Also, your legal age, obviously,
Yeah.
and the name of the registered representative handling your account. If there's more than one rep, they need to spell out exactly who's responsible for what.
Okay.
And finally, the signature of a principal, like a manager or partner at the firm, approving the account. That signature is them saying, yep, we've checked everything.
So the firm takes responsibility with that signature. What if it's, say, a company opening an account, not a person?
Good question. If it's a business, the rep needs the names of the people authorized to make transactions for that account. And before the first trade settles, they also need to make a reasonable effort to get the company's tax ID number, your personal Social Security number, if applicable, your occupation, employer's name and address.
Wow. Okay.
And also if you're connected to another investment firm. Though interestingly, some of that detail occupation, employer, doesn't apply for like huge institutional accounts or if you're only buying certain types of mutual funds without a recommendation.
That's a lot of info. Okay, speaking of signatures, does the customer, do I have to sign that new account form?
Ah, great question.
Huh.
And this might surprise you. The principal has to sign to approve it. But for a basic cash account where you're just using your own money, the industry rules don't actually require your signature.
Really? Why is that?
Because with a cash account, the firm isn't taking on as much direct risk, you know. It's your money. But if you want to open a margin account where you borrow, or an options account, which is more complex,
Then I need to sign.
yes, then your signature is required because you're taking on leverage, more risk. The firm needs your explicit sign-off acknowledging that extra risk.
I see. So the firm's responsible even if I don't sign for a cash account. That really shows their obligation.
Yeah.
Are there other rules besides FINRA's, like from the SEC?
Oh, absolutely. The SEC, the Securities and Exchange Commission, kind of the top regulator, they have rules too. They require broker-dealers to keep really detailed customer files.
More details, like what?
Yeah, so name, tax ID, address, phone, date of birth, employment status, occupation, if you work for another broker-dealer, and crucially, your annual income and net worth, but not counting your main home and your investment objectives.
Okay.
Plus, anything about your past investment experience, that's all vital for figuring out suitability later. Interestingly, they don't need your educational background. That's not required.
What if someone just refuses? Like they don't want to share their income or net worth. Can they still open an account? It feels intrusive to some people, I bet.
Yeah, it can feel like that.
Yeah.
If a customer won't provide certain info like financial details, the rep should, just make a note of it, document that they ask.
Yeah.
It can be simple, just write refused on the form. But ultimately, the principal approving the account can refuse to open it if they feel they don't have enough information to properly assess your investment goals or suitability. They need enough to protect you and meet their own rules.
Makes sense. They need to cover themselves and you. What about this trusted contact person thing I've heard about? Is that new?
It's relatively new, yeah, and
Yeah.
quite important. It addresses the question, who can the firm call if they suspect something's wrong or can't reach you?
Right.
So when you open an account, the firm has to make a reasonable effort to get the name and contact info for a trusted person you choose.
Okay.
And if they get that info, they have to tell you in writing that they're allowed to contact that person under certain circumstances. Like if they suspect financial exploitation, or maybe they just need to confirm your contact details, check on your health status if they're concerned, or figure out who has legal authority, like a guardian.
So it's like an emergency contact, but specifically for financial safety.
Exactly. It's another layer of protection, a proactive safeguard.
Okay, so the account's open, all this info is gathered. Is that it? Does the file just sit there?
Oh, no. Definitely not. It's crucial that it stays up to date. They need to send you a copy of your account record, or at least the key information, within 30 days of opening the account, or maybe with your first statement.
Right.
And then, periodically, they have to send you updates for verification at least every 36 months, so every 3 years.
And if I tell them something changed, like my address?
Yep. If you give them updated info, they have to send you a revised record within 30 days, or, again, with your next statement. And for something like an address change, they actually have to notify both your old address on file and the rep handling your account also within 30 days.
Wow. Okay. Very thorough. So that covers getting the account set up and keeping the info fresh. It's a detailed process.
It really is.
Now let's shift to what feels like the core of good financial advice, suitability. This seems like where that know your customer stuff really pays off, right?
Absolutely. It's KYC in action. The broker-dealer has to use that reasonable diligence to learn the essential facts about you. You have to know your customer to give them the right service.
Right.
And this applies even if you've given someone else, like an investment advisor, authority to trade in your account. The point is, only after the rep truly understands your financial needs, your whole picture, can they make suitable recommendations.
So suitable means suitable for me specifically. What defines that?
That's the heart of it. Broker-dealers have this suitability obligation. For regular folks, retail customers like you, they need a reasonable basis for recommending any specific transaction or even a strategy, like, say, day trading or using margin.
Okay.
And those recommendations have to be based on the information they got from you, all that stuff we talked about, which builds your investment profile.
And what's in that profile? Just my age and how much money I make.
Oh, much more. It's really a comprehensive snapshot. Your age, yes, but also other investments you might have, your overall financial situation and needs, your tax status, your investment objectives, like are you saving for retirement or a house down payment? Also your investment experience, your time horizon, how long you plan to invest, for your need for liquidity, meaning how quickly you might need cash, your tolerance for risk. That's a big one.
Yeah.
And really any other relevant info they get from you. Now, you don't have to provide every single detail, but the rep should try hard to gather as much as possible to make the best recommendations. These rules are basically your main defense against bad advice or predatory sales tactics.
So it's really truly supposed to be about my best interest, not just what gets the rep the biggest commission.
Precisely. It's a very clear line. The recommendation must always be in your best interest, not the representative's. And just because you might say okay to a recommendation doesn't let the firm off the hook for suitability.
So even if I agree, they still had to do their homework. Exactly. There are clear examples of violations,
Yeah.
like recommending one product over another just because it pays more commission, or pushing certain mutual funds to max out their payout instead of building a sensible portfolio for you, or suggesting you use margin just to generate more trades and commissions, or maybe heavily promoting a new stock offering just because their firm wants to unload it.
Wow. Okay, so very clear boundaries. Are there like different types of suitability they look at?
Yes, FINRA breaks it down into three main obligations that kind of work together. First is the reasonable basis obligation. This means the firm and rep need a solid reason to believe the investment is suitable for at least some investors. Basically, if they don't understand the product, they shouldn't recommend it to anyone.
Okay, baseline suitability.
Right. Second is the customer-specific obligation. This is key for you. They need a reasonable basis to believe the recommendation is suitable for you specifically based on your unique profile we just talked about.
Got it.
And third is the quantitative obligation. This one looks at a series of trades. Even if each individual trade seems suitable, are they doing too many trades? Is it excessive, like churning the account? When you look at your overall profile and goals, it's about the big picture, the cumulative effect.
Ah, so not just one bad recommendation, but maybe a pattern of excessive trading. What about age? Does being older automatically mean low risk only?
That's a common question. Age is usually just one factor among many. For younger clients who are okay with more risk, maybe their objective is growth or even speculation, and that could be perfectly fine.
Right.
It gets a bit trickier with income-focused investments because those range from, really risky junk bonds to super safe treasury bonds. So age alone doesn't dictate that.
So it depends on the goal.
Exactly. There are situations where age might be almost irrelevant. Like if you need money quickly liquidity for a short-term goal, your age doesn't really matter. Getting the cash is the priority. Same for preserving capital. Safety is the main thing, not how old you are.
Okay, that makes sense. What are the big players like banks or pension funds? Are the rules different for them versus, me?
They can be. Institutional suitability depends on how sophisticated the institution is. Some manage billions and know exactly what they're doing. Others might be smaller, less experienced.
Right.
So for a broker-dealer dealing with an institution, there are two main things. First, they need a reasonable basis to believe the institution can evaluate the investment risks themselves independently.
Okay.
And second, the institution has to actually say affirmatively that they are exercising their own independent judgment on the recommendations.
So they have to confirm they're making their own calls.
Pretty much. If those conditions are met, the firm is exempt from that customer-specific suitability piece we talked about. But the reasonable basis and the quantitative, the excessive trading rules, those still apply even to big institutions.
Got it. Okay, let's switch gears again to something huge that impacts everyone. Anti-money laundering, or AML. Sounds kind of intense, like fighting financial crime globally.
It is intense. And yeah, it often gets portrayed like spy movie stuff, but it's very real and incredibly important. Think of AML as the financial systems like immune system fighting off dirty money.
Okay.
The main law in the U.S. is the Bank Secrecy Act, the BSA, but it got a major update with the USA Patriot Act.
Right, you mentioned that earlier.
Yeah, specifically aimed at detecting, deterring, and disrupting terrorist financing networks that rely on laundered money. After 9/11, the Patriot Act really pushed these AML requirements to the forefront for investment firms.
So how does money laundering actually, work? Is there a standard playbook criminals use?
Generally, yeah, there are three stages people talk about.
Yeah.
First is placement. This is where the bad guys get the illegal cash into the legitimate financial system, often by buying securities or something similar, like walking in with cash.
Okay, getting the foot in the door.
Exactly. The second stage is layering. This is where they try to obscure the money's origin through lots and lots of complex transactions, making it hard to follow the trail.
How do they do that?
Well, one common tactic is called structuring. Maybe they buy several chunks of securities with cashier's checks from different banks, each under $10,000, so they don't trigger automatic reporting.
Trying to fly under the radar.
Right. Or they might do really complex things, like taking opposite positions on the same stock or using multiple customer accounts. Anything to muddy the waters.
That sounds like a real shell game. What's the final step?
That's integration. This is where the laundered money, having gone through all those layers, gets reintroduced into the regular economy, looking clean.
Oh.
For example, maybe those securities bought with dirty cash are sold. The money from the sale goes into a bank account. Then they spend that money on normal stuff, cars, houses, businesses. Once it's spent, it looks legitimate. It's integrated.
Wow, that's sneaky. How does the government even track this? Who's in charge of stopping it?
A key player is FinCENALI, the Financial Crimes Enforcement Network. They're part of the Treasury Department. Their job is basically to create and enforce policies against money laundering.
And how do they do that?
Two main ways. First, they require financial institutions, like broker-dealers, to file certain reports about transactions under the Bank Secrecy Act. Second, they share the information from those reports with law enforcement to help them actually catch the criminals.
What kind of reports are we talking about?
The big one is the BCTR Bank Secrecy Act Currency Transaction Report. Broker-dealers have to file one of these for any cash transaction over $10,000 by a single customer in one business day.
Over 10,000 in cash. Got it.
And that includes actual physical cash, coins. It also gets triggered if a customer does several smaller cash transactions in one day that add up to more than $10,000.
Oh, okay. So they can't just split it up easily on the same day.
Right, like if you deposit $6,000 cash in the morning at one branch and then $7,000 in traveler's checks, which can count like cash in some contexts at another branch later that day, boom, that's over 10K total, so a BCTR needs to be filed.
That's smart. So deliberately staying under $10,000 in multiple transactions, that's the structuring you mentioned.
Exactly what it is. That's a classic red flag. Reps are specifically trained to watch out for clients doing multiple transactions just below that $10,000 limit, or maybe depositing lots of sequentially numbered money orders. It signals someone might be trying to evade the reporting.
What if something just seems weird or suspicious, even if it's not cash or not over $10,000?
Good point. That's where SARs come in. Suspicious activity reports. Before the Patriot Act, it was mostly banks filing these. Now, any investment firm has to file an SAR if a transaction, or a group of them, hits $5,000 or more, and the firm suspects something fishy.
Suspects what exactly?
Well, several things. Maybe they think the client is breaking federal criminal laws, or the money seems tied to illegal activity, or the transaction looks like it was designed specifically to avoid reporting like structuring. Or maybe the transaction just seems to have no logical business purpose, and the firm can't figure out a reasonable explanation for it after looking into it. Basically, if it just doesn't add up.
That feels like a really important safety net. If a firm files one of these SARs, does the customer find out?
Absolutely not. And this is crucial. Filing a SAR is completely confidential. The information in it is confidential. A rep can never tell the person involved that a SAR has been filed about them.
Never.
Never. Disclosure is only allowed to federal law enforcement or securities regulators. It has to be tightly controlled. Otherwise, criminals would just change tactics, right? It protects the investigation.
Wow. Okay. So we've really covered a lot of ground today, from all the details needed just to open an account and build that financial profile.
Yeah, the digital fingerprint.
Right. To the absolute importance of suitability, making sure advice is genuinely in your best interest.
The core of the relationship, really.
And then these really robust efforts behind anti-money laundering to protect the whole system. It seems like rules that might feel bureaucratic are actually vital layers of protection.
That's exactly it. And if you zoom out, the whole point of all these regulations, KYC, suitability, AML, it's about protecting everyone involved.
Yep.
You, the customer, the firms, the reps, and on a bigger scale, detecting and stopping illicit finance, like funding for terrorism. All that documentation, the ongoing monitoring we discussed, it creates these essential safeguards for the financial system. Yeah. Like you said, the immune system analogy works well.
Yeah, it really does. We've seen just how much goes into making sure financial transactions are, legitimate and suitable, which kind of leads to a final thought.
Okay.
With technology changing so fast, crypto, AI advisors, instant global payments, what new challenges do you think are popping up? How do we keep our financial systems both super secure and easy for people to use?